students, today we are going to learn and discuss about income from house property. Introduction to income from house property. Students, as we learnt in income tax that there are 5 heads of income, namely income from salaries, income from house property, income from capital gains, income from business and profession, and income from other sources. So, this income from house property is the second head of income under the Income Tax Act 1961. So, let us move on to introducing the income from house property. Income from house property is the second head of income under the Income Tax Act of 1961. So, section 22 to 28 of the Income Tax Act of 1961, it deals with the provisions relating to income from house property. So, students, what is income from house property? So, income from house property simply means it can be your home, an office, a shop, a building, or some land which has been attached to the building like a parking lot. So, it is said that the Income Tax Act, it doesn't differentiate between a commercial and a residential property, which means all types of properties are attached under the head income from house property and have been confined to the income tax returns. Now, the underlying principle and the basic concept under this head is that income from house property here is being charged on the notional basis or the annual value of that building. Moving on to the chargeability of the income under the head house property. So, students, let me tell you that the basis on which the income from house property is being put to tax is under section 22. So, therefore, the charge on which the property income is put to tax is on the basis of the annual value of the property. Now, let us understand what is annual value of the property. Annual value of the property simply means that it consists of any building or land which has been attached thereto, where the condition lies that the assessee is the owner of the property. So, any such incomes which is being earned under this head will be put to tax under the head income from house property. For example, Mr. X is the owner of 3 houses, and out of 3 houses, suppose say that one house is being let out and the rent which is being received or receivable from this house here is being put to tax under this head income from house property. So, which means the value at which the income is being put to tax is the annual rent received or receivable by the assessee. So, another important point to be noted is that any income from houses, buildings, bungalows, godown are also being assessed and put to tax under the head income from house property. So, at this point of time, students, let me tell you all the formula to compute income from house property. So, since we learnt in the class now that the basis on which the incomes from house property are put to tax is on the annual value of the property. So, therefore, your income from house property is equal to annual value of the property minus deductions under section 24. Now, let us understand the characteristics of income from house property. Now, the characteristics of income from house property also means the conditions what is to be fulfilled or satisfied in order to be put to tax under this head, that is under section 22 of Income Tax Act of 1961. Now, let us go through conditions one by one. The first condition is the property must consist of buildings and land appurtenant thereto. Now, let me briefly explain this first condition. Now, the property must consist of buildings and land appurtenant thereto means that any land which has been attached to the buildings, provided there is some income which has been earned from it, then that income will be considered as income from house property which has been chargeable to tax under this head. So, which means to note that the standing instruction that any huts or any kind of the tents which has been built, like for example students, many students would have joined NCC or many students will go for camps. So, that is a temporary erection. So, that temporary erection here you cannot charge that under the head income from house property. Now, the second important basic condition and the characteristic of the income from house property is the assessee must be the owner of the property. Now, what is mean by the assessee must be the owner of the property? It means that it is a legal ownership of the house property which is important and not the mere possessing of the property. Next, we move on to the third condition or the third characteristic of income from house property. Now, the third characteristics emancipate that the property must be used only for the purpose of taxing under this head, but not to be used for the business or profession. Hope students you are understanding. Next, we move on to exclusions. What do you mean by exclusions? No doubt, the income which has been got and earned from the house properties is being put to tax. But as per the Income Tax Act of 1961, there are certain incomes which are excluded, which means there are certain exempted incomes. Now, let us learn quickly and briefly a few exempted incomes which has been not considered while calculating the total taxable income. First one, income from the house property in the vicinity of the agricultural land. Second one, any income which has been earned by an ex-ruler is not been considered and not charged under the head income from house property. Next, any income which has been earned from the farmhouse. Next, any income which has been earned from the self-occupied house property, which means where we have three houses. Let us suppose say we have house 1, house 2 and house 3. House 1 is used for residence and house 2 is used for business and house 3 is being again used for other purposes. So, that house property here which is being used for own use is being exempted under section 23. Next, we have another property income which has been exempted, that is the property income which has been or the property here which has been used for charitable purpose. And next, house property which has been used for own business or profession. And lastly, any house property of the registered trade union or the local authority here will be completely exempted and not to be considered while calculating the taxable income from house property. Moving on to annual value, which has been given and explained under section 23 subsection 1. Students, we all learnt in the beginning that the basis of charge or the chargeability under section 22, where the value of the house property or the income from the house property is put to charge on the basis of annual value of the property. So, which means that the annual value of the property is very important for calculation of the income from house property. Why? Because it depends upon the calculated annual value. Now, what is this calculated annual value? Now, the calculated annual value here is nothing but actually it is the rent received or receivable which has been expected year after year. Next is, let's understand and learn the definition of annual value under section 23. Now, as students of income tax, you need to understand and also learn the definition as per section. Now, let's go through the definition. According to section 23 of Income Tax Act of 1961, Annual value of the house property simply means the sum or the total value of the property which might reasonably be expected to be let out from year to year. Now, what is the simple meaning of this definition? Let's analyze the definition. Now, the definition here is being analyzed as where the annual value of the house property simply means the rent which is being expected year after year. Now, let's learn the format to determine the calculation of the gross annual value which is being defined under section 23 subsection 1. So, the following slide basically depicts the format how to calculate the gross annual value which is the basis of chargeability under the head income from house property. Now, in this, let's quickly go through the format and then I would like to explain each and every factor which has been considered in determination of the gross annual value under section 23 subsection 1. Okay. So, the format goes like this. First, given the problem, look into the factors whether municipal rental value is given. So, municipal rental value you need to record, and after which you also need to take the fair rental value. So, between the municipal rental value and the fair rental value, you take whichever is higher. Then, in case the problem also states the standard rent, then you take between whichever is higher and the standard rent whichever is less. Now, that whichever is less is called as expected rental value. Now, in case the actual rent also is being given, then you need to consider the actual rental value also to determine the gross annual value. Then, from the expected rental value and the actual rental value, you take whichever is higher. Then, in case the house remains vacant for 2 months, then you call that as vacancy period and you reduce and do the adjustment from the actual rental value. So, the vacancy period is being reduced and the formula used to calculate the vacancy period will be vacancy period into actual rent for vacancy period. Now, finally, you arrive at the gross annual value. Moving on to the explanation of the format of how to determine the gross annual value. Like I said, the fair rental value, municipal rental value, actual rental value and the standard rent are the factors which have been taken into consideration in determining the gross annual value of the house property. Now, let's understand and know the meaning of fair rental value. What is fair rental value? Okay. Fair rental value here is nothing but it refers to the rent of a similar type of house in the same locality. Next, municipal rental value. As the name itself indicates here, municipal rental value, it refers to the value which has been fixed by the municipal authority or the local authority. The third important factor is the actual rental value, which is simply called as ARV. Now, it is also called as de facto rent. So, this is nothing but the rent which has been fixed for a property and which has been actually let out by the owner. Next, standard rent. Now, what is standard rent? Standard rent here is nothing but it refers to the rent which has been fixed by the Rent Control Act, or in other words, it simply means the maximum rent an owner can claim from his tenant as rent whenever the standard rent is being applicable for a property. Now, at this point, as we saw in the format, you also need to know the concept of ERV. What is ERV? ERV is nothing but where you take between MRV and FRV whichever is higher, and in case the problem gives the Standard Rent Control Act is applicable, then you compare between MRV and FRV, whichever is higher, select the highest amount, and between this you take whichever is less, and that is being treated as expected rental value. Next is moving up to, now till now we have learnt on what basis the house property is being put to tax, and we also did discuss about the annual value, the definition of the annual value, and what are the factors that can be considered while calculating the GAV. Now let's understand the determination of the annual value for different types of house properties. So let me just quickly and briefly tell you about the categories of the house property. Now following are the important categories of the house property. 1. We have let out house property. 2. We have self-occupied house property. 3. We have deemed to be let out house property, and 4th we have the house properties which can be let out for a part of the year and for part of the year self-occupied, and sometimes there might be some property which can be apportioned 3/4 and 1/4. Now after learning the categories of the house property, now let's understand how to determine the annual value of the house properties. So firstly, I'd like to explain the property which has been let out throughout the previous year under section 23(1) subsection A and B. So when the property is been let out throughout the previous year, how do you determine the GAV? So a GAV will be higher of the expected rental value and the actual rent received or receivable during the year. So which means your annual value will be GAV minus municipal taxes paid by the owner during the previous year. Moving on to the next type of the house property, where we are going to learn how to determine the annual value for the given house property. So the second type is where the let out house property is vacant for part of the year. So when the LOP is vacant for part of the year, which means that suppose say there are two houses, house 1 and house 2, house 1 is let out and house 2 remains vacant for 3 months. How do you calculate the annual value? Then your annual value will be the actual rent which is lower than the ER, and the actual rent received or receivable will be equal to the GAV of the house property. Moving on to the third type of the house property to learn how to determine the annual value of the house property, which has been explained under section 23 subsection 2. So where the self-occupied or where the property is being self-occupied for own use or own residence throughout the previous year. Now what is this previous year? Previous year is nothing but here the year which commences from the April and ending on 31st March, which means you are the students of the assessment year 22-23. So for this assessment year, you compute the GAV for the previous year 21-22. Moving on to the computation of GAV for the self-occupied house property. Okay. So in case of the self-occupied house property, there is no benefit being given to the individual, but there is only one deduction which is being given here, that is interest on borrowed capital. Moving on to deductions from the annual value, which is being explained under section 24. So there are two deductions here which is being given under section 24. One, the standard deduction, that is irrespective of the actual amount what is being given in the problem, that is with regard to repairs, renewals, but you need to allow only 30% of the net annual value. The second deduction which is to be given under section 24 is interest on borrowed capital. Now this interest on borrowed capital comprises of two types of interest. One, current year's interest, and the second one is pre-construction period interest. Now, what is this pre-construction period interest and current year's interest? Now, current year's interest here is nothing but, now when a loan here is being borrowed, for the property which is being acquired for construction purpose or for the renovation purpose, then the amount of interest what is being calculated on the loan what is being borrowed. So, that is the current year's interest which is being allowed as deduction. And the second type of interest which is being allowed is pre-construction interest. The very word pre-construction interest simply means that the interest which is being paid for the period prior to the previous year in which the property is being acquired are allowed as a deduction. Next is deemed ownership under section 27. So, while computing the total taxable income from the house property, students, you also need to know about the deemed ownership, because one of the condition to be fulfilled or satisfied for a property income to be included under the taxable calculation is the actual ownership here. Now, sometimes the deemed ownership also here will be included and considered while calculating the total taxable income. What is deemed ownership? Now, deemed owner here is nothing but, the very word itself here it implies he is not the real owner, but that owner here in certain situations he will be treated as an actual legal owner, where he will be liable to pay tax in the same manner of any owner. Now, let's move on to the circumstances where a person here is said to be the deemed owner. Under the Income Tax Act of 1961, that is under section 27, there are certain circumstances where a person here is deemed to be the owner of the property even though he is not the legal owner thereof. Let's quickly go through certain circumstances. Now, following are the circumstances here where the deemed ownership here is being treated as the legal ownership. Transfer to the spouse or the minor child, holder of impartible asset, member of the cooperative society, person in possession of the property through attorney. Moving on to co-ownership. The next important concept in the house property which the income tax students should understand is co-ownership. Now, the co-ownership here is being defined under section 26. What is co-ownership? As the name itself indicates here, under section 26 of the Income Tax Act of 1961, it clearly states that when two or more persons owns the property and when their respective shares are definite, fixed and ascertainable, then that is co-ownership, and you cannot treat it as association of persons. Example, if a person owns 100% of a company, then she is a owner of that company, and if a person has a partner with equity in the company, then that person is called to be as co-owner. Now, let's quickly move on to the treatment of different incomes. Now, before we work out the problems on the calculation of the taxable incomes under house property, let's quickly grasp the treatment of different incomes. 1. Income from house property situated abroad. Now, this property income is being taxed only in the hands of ROR, that is resident and ordinary resident, and not taxed in the hands of not ordinary resident and non-resident. Now, second important treatment is disputed ownership. Now, in case there is any dispute regarding the title of the ownership, then the beneficiary will be taxed. Next up is property as stock in trade. How do you treat? Now, this has been treated as income from let out house property, irrespective of the fact that the assessee is holding the property as stock in trade, and any property which is being owned by the owners, that is when the property is being owned jointly or severally here, and when their shares is being fixed and definite, then that will be put to tax separately in the individual capacity and not assessed as AOP. Now, subletting. Now, when you are working out the problems, you also need to understand about subletting. Now this subletting, any income which is being earned on the subletting, students, that will be not taxed under the head income from house property, but it will be taxed under the head income from other sources. Now let us understand with an example what is subletting. Mr. M, he lets his house to Mr. S for rupees 25,000 per month, and in return Mr. S, he sublets to Mr. D for rupees 15,000 per month. So here for Mr. M, the income will be taxed under the head income from house property since he is the owner for Mr. S. But for Mr. S, the income will be taxed under the head other sources as he sublets the property to Mr. D. Now let us understand the treatment of composite rent. Now composite rent here is nothing but, as the name itself indicates here, it consists of two types of rent. One, rent of the building and rent of the facility. Now rent of the building here is nothing but the rent which has been payable, and rent of the facilities here is nothing but basically it implies the services like the lift, watchman, air conditioner, electricity and other assets. Move on to situation 1 of treating the composite rent. Now where the composite rent includes rent of building and charges for supplementary services, then the value of such services shall be determined under the building rent, and that will be taxed under the head house property, and the services will be taxed under the head other sources. Situation 2, where the composite rent includes rent of building and other assets, that means where they are inseparable, then they are being taxed under the head income from other sources. Situation 3, where the composite rent which includes rent of building and other assets, when they are separable, then that portion of the rent what is been attributable to the building here, that is been taxed as house property income, and the rent for other assets is been taxed under the head income from other sources. Moving on to which are the amounts which are not deductible under section 25. Okay. So the following are the amounts which are not deductible: 1, interest chargeable, and 2, loan which is being taken to repay the outstanding interest, and 3rd, interest on delayed payment of interest. Next up, we are going to learn how to treat the loss from house property. Any loss which has been incurred from the house property, that can be set off from any income of the same year. The computation of the income from house property. As I already shown the format how to compute, so I will just quickly explain this format with an illustration here. So the format used to compute the income from house property is gross annual value, and from the gross annual value you reduce the municipal taxes, that is the municipal taxes which is paid by the owner only should be deducted and not by the tenant, and we arrive at net annual value, and from the net annual value you give the deductions under section 24, that is standard deduction, and second one is interest on borrowed capital, and finally you arrive at income from house property. Now there are the treatments here. One treatment of is unrealized rent. So in case the problem specifies the rent which is not been paid or unrealized, then you adjust it from the ARV, and similarly the treatment of the rent recovered and arrears of rent here, you add it here after the standard deduction. Let me now explain how to compute the gross annual value. So given the problem here, you can see there are two houses, and the factors given here are MRV, FRV, standard rent and actual rent. So how to compute the gross annual value. So the following is a format here and the solution here to compute the gross annual value. So given the problem, you take between MRV and FRV whichever is higher, and since the standard rent is given here, so you take whichever is less, you arrive at expected rental value, and also the actual rent is being received here, and you take whichever is higher, you arrive at GAV.